Very welcome to Achievers Meeting Point once again. So today we are going to have a brief share in the conceptual framework for financial reporting. And the conceptual framework for financial reporting was majorly issued out by the International Accounting Standards Board in September 2010. But however, it was revised in March 2018 in order to catch up with the new generation, with the new changing era. And after being revised in March 2018, it was to start effectively on 1st of January 2020. So from 1st of January 2020, all entities were required to start using the new conceptual framework. So that's the brief introduction of our conceptual framework, and it is majorly done by the International Accounting Standards Board, who normally review it after a given period of time. So majorly in this conceptual framework, we're going to look at how many chapters it has. So it has 7 chapters, whereby it gives an overview of how you're supposed to report in your financial statements. So the chapter 1 is the objective of the general purpose financial reporting. Why do we do this financial reporting? So that's what we're going to look at. We're going to look at chapter 2, which looks at the qualitative characteristics of useful financial information. We'll look at the financial statements and the reporting entity. We look at the elements of financial statements. We look at the maybe the reporting, the recognition and the recognition. We will look at measurement. Yeah. Then lastly, we can look at an element at the chapter called chapter 7, which is called presentation and disclosure. So let's start with our first chapter, which is the objective of financial reporting. So the major objective of financial reporting, why do you do financial reports? The major objective is to provide financial information that is useful to users in making decisions. Whichever accountant, whichever auditor, whichever person who does financial reporting, his major objective is to provide that financial information that is useful to users in making decisions relating to providing resources to the entity. We have different users of financial information. To mention but a few, have examples like lenders, we have examples like investors, we have examples like the government, we have examples like managers. All those people need the financial records, they need the financial reporting, and they use it to make their own decisions. So that's the major objective of financial reporting. So we're going to look at so whenever the users are making information, they can make information maybe about buying, selling, or holding equity or debt instruments for the entity. They can make information on providing or settling loans and other forms of credit. Now those are lenders and banks and state banking and finance institutions. Voting or otherwise influencing management actions, that we can talk about the investors, the shareholders. So now whenever to make both these assessments, to make these decisions, users will need information about the entity's economic resources, the claims against the entity, which are those claims, liabilities, and changes in those resources and claims. So that's the first objective of financial reporting. I want us to look at chapter 2, which is qualitative characteristics of financial information. So the qualitative characteristics of financial information are classified into 2, being the fundamental qualitative characteristics and the enhancing qualitative characteristics. So for the fundamental qualitative characteristics, there are majorly 2, that is the relevance and faithful representation. So for information to be useful, that's being fundamental, it must be both relevant and faithfully represent what it purports to represent. So those are the 2 fundamental qualitative characteristics. But whereas when this information is got, so to enhance its usefulness, we put in the enhancing qualitative characteristics, that is the comparability, verifiability, timeliness, and understandability. So I want us to look at those qualitative characteristics so we can look at how they are applied. So the first characteristic, that's the fundamental one, it is in relevance. So under relevance, we look at the information you have. It must have that feature that it can be able to influence or make users change their own decisions. That in case you change your own, you change that information, it can easily influence the user to change his or her decision. So that means it is relevant. That a mere change in your information, it immediately changes someone's decision that is supposed to make. That is being relevant. So, and to be relevant, information to be relevant, it must have the two points. That is the predictive value or the confirmatory value. It must have both the predictive value and the confirmatory value. Talking about predictive value is that it has that point, the predictive value, that you can use it to predict future results of a company financially. That's the predictive value. Whereas confirmatory is that when you reach at a certain point, I can confirm with what I had predicted. That is the predictive value and the confirmatory value. So information to be relevant, it must have both the predictive value and the confirmatory value. That is relevance. Whereas faithful representation, we're talking about that information must fully represent what it purports to represent. And information to be faithfully represented, it must have at least three characteristics with it. So the information must be neutral. When talk about neutral is you're not biased. You're on a neutral point. It's not a positive, it's not a negative, but you are on a neutral point. The information you provided is not biased on anyone, but simply you are on a neutral point. Then it must be complete. When talk about complete, that means it must contain all whatever is needed. All whatever is needed in that situation. That's why we have financial statements having the financial statements having the three financial statements. That is the profit and loss, the balance sheet, and the changes in equity. So, and after that ones, where you are supposed to put disclosures, you're supposed to put notes and disclose to the users of the financial information what you have put in the financial statement. That is being complete. You have included all what the user needs. Then free from error. So free from error, your information must not have any error within it. That means, okay, sometimes you may not be able to avoid error, but at least try to minimize the error within it. So those are the fundamental qualitative characteristics. So after you're making information, its usefulness can be enhanced by the four enhancing qualitative characteristics, where we have the comparability, meaning that comparability, I can compare this information either with previous years or with different entities whereby we're using the same financial statements. That is comparability, that you can compare it can be comparable, and you can't compare something that's not alike. It's like getting a car and you compare it with a motorcycle, which is unrealistic. They're not looking alike, just they perform the same purpose. So even your financial statements, they must have that characteristic that they can be compared. Then verifiability, that under verifiability, can we bring two people? Can we bring two or more independent people and they reach to one agreement? That if I give my financial statement to person A, I give my financial statement to Gloria, I give my financial statement to Atasha, I give my financial statement to Vicky, will all these people reach on one agreement? Okay, that is another enhancing characteristic. Then timeliness is that the information you provide, is it provided in time? If we know that always supposed to provide information at the end of June, how come the information is being provided in August? So that means it is trying to lose its importance. We are losing the importance of financial reporting. Then you look at in understandability. So we all know that not all people could have done accounting. Not all people could have the knowledge of understanding the financial reporting. So now you are supposed to endeavor to make a financial report that is understandable by each and every person. that even to a mere person who completed the senior 4, you can give him this final statement and read it and understand. So it must have that understandability within it, that everyone can easily understand it. So those are the enhancing qualitative characteristics that enhances its importance or usefulness. So let's look at chapter 3. Those are the final statements and the reporting entity. So we're looking at the financial statements. We all know financial statements. So we said the financial statements, when define it, it's a form of an individual, is a form of financial reports that provides information about the reporting entities, assets, liabilities, equity, income, and expenses. It's just a form of financial reports. A form of financial report. There are different forms. But what's role? Providing information about the reporting entities, liabilities, equity, income, and expenses. Those are the elements now of financial statements. We'll look at them. Whereas the reporting entity is that entity that is required or chooses to prepare financial statements. You may be required by law to prepare the financial statements, or you may just choose to prepare the financial statements. So whatever you are, you become a reporting entity. Good. Let's continue. So now, after understanding the financial statements and the reporting entity, we have different types of financial statements. Majorly, we have 3. So the other ones are forms, but now we have types of financial statements. We have the consolidated financial statements. Under consolidated financial statements, this is where the financial reports are providing information about assets, liabilities, equity, income, and expenses of both the parent and the subsidiary in a single report, as a single reporting entity. Take, for instance, I have MTN South Africa. MTN South Africa being the parent of MTN Uganda. So in case they provide the financial statements of these two companies as one reporting entity, then that is a consolidated financial statement. But now when you go to unconsolidated financial statement, this provides information about assets, liabilities, income, expenses, and equity of the parents. It can provide either of the parent alone or of the subsidiary alone. In case MTN South Africa prepares its own financial statements, that means that's an unconsolidated financial statement. Then look at the combined financial statements. Combined financial statements, when you come together two companies which are not related with a parent subsidiary relationship, but they combine together to make financial statements. For example, I'll give an example of Nightil and Pick Fair. These two companies they're not having a parent subsidiary relationship, but these two companies can make one financial statement. So that is making a combined financial statement. So I hope you have got some criteria about the reporting entity and the financial statement. Let's look at chapter 4. Those are the elements of financial statements. We have 4 elements of financial statements. We have 5 elements. Where we have the assets, we have the incomes, we have the expenses, we have the equity. So we're going to look at now those financial statements, the elements of the financial statements, and see what they are. So for example, we'll start with assets. What are assets? So assets are economic resources, are present economic resources controlled by an entity as a result of past events. So it is a present economic resource, but being controlled by who? By an entity. But it must be controlled by an entity as a result of past events. So that means the past event is one which caused us to have this economic resource. So I must be controlling, but I had bought it. That's when it becomes an asset to me. So it's a result of a past event which happened. Either I bought it, or I got it from a loan, or I got it from something. It becomes to be an asset to me. So an asset is a present economic resource controlled by an entity as a result of past events. Yeah. So whenever you have to have an economic resource, you look at 2 items. How do you determine it to be an economic resource? It must have 2 items. It must have a right. You must have its rights on it. And then it must have that potential to produce economic benefits. And the third one is control. So if company X has a car, does it have rights and obligations over it? In the case it has rights and obligations over it, that means it is an asset to them. Then look at does that car have the potential to produce economic benefits? And those economic benefits, are they going to flow towards the entity? That's an asset to them. And then does the entity have control over the asset? That's an entity that becomes then an answer to them. Let's look at liabilities. So liabilities, or as liabilities, is the present obligations of the entity to transfer an economic resource as a result of past events. So it is your obligation, a present obligation which you have to transfer an economic resource as a result of past events. Examples of liabilities. For example, I'm being demanded by Tasha. So in case I'm being demanded, there is a past event which occurred, which is now tying me to pay Tasha, just because either she gave me goods on credit, or it became an obligation to me. So it's a past event like 3 weeks back that took place, but now it is putting me on that note to pay the item. So it's a liability to me, but it's a present obligation that I have, and it's a result of past events. So for a liability to exist and for an accountant to recognize that a liability is existing, the entity must have an obligation. You can't have a liability and not have an obligation. So it must have an obligation. Then, and the obligation is supposed to be to transfer an economic resource, and that obligation must exist as a result of past events. So there are 3 criteria. The entity must have an obligation. The obligation should be to transfer an economic resource, and the obligation should be present as a result of past events. So, majorly those are the 2 items that were changed in the new conceptual framework that was issued in 2018. So let's look at. Also, I will just look at the other 3. Where we have the equity, where we have the incomes, where we have the expenses. Yeah. So under equity, that's the net assets of an entity after subtracting all its liabilities. We all know that it's a net asset after subtracting all its liabilities. Whereas expense, so equity is the residual interest in the assets of the entity after deducting all its liabilities. That when you get all the company's assets and subtract all its liabilities, so what you remain with is what we call an equity. That's what we call equity. That's the shareholders' money. So from the accounting equation that assets equals liabilities plus equity. So when you subtract liabilities from assets, you get equity. Whereas income is increase in assets or decrease in liabilities as a result that results in increase in equity other than those relating to contributions from holders of equity claims. So it is increase in assets or a decrease in liabilities, but resulting to increase in equity, but other than those relating to contributions from shareholders. Then expenses are decrease in assets or increase in liabilities that result in decrease in equity other than those relating to distribution to holders of equity claims. Good. Let's look at recognition and recognition. So recognition is the process of capturing for inclusion in the statement of financial position or the statement of financial performance an item that meets the definition of an asset, liability, equity, income, or expenses. So that process of capturing information, whenever you capture information, but to include capturing information for inclusion in the statement of either P&L or the statement of financial position. But what are you including? That I'm including an item that satisfies the definition of asset, liabilities, income, expenses, and equity. So you're doing what we call recognition. Yeah. So, whereas the recognition is the removal of all or part of a recognized asset or liability from an entity's statement of financial position. So the removal of all or part of an entity's liabilities or assets in the statement of financial position. In the next video, we'll look at under recognition, which will have 3 levels of recognitions according to percentages. What do you do and what you are not supposed to do? We shall look at it in the next video. Then chapter 6, that is measurement. Under measurement, we'll look at the different types of measurements that an accountant is supposed to apply. So we have at least like 4 or 5 So we have the historical cost measurement, which most people use to. This unhistorical cost measurement, it will be based on the historical cost. How much do you buy that car? So you're measuring the asset at the amount you bought that car. But whereas sometimes we go as a depreciating each year, we remove the depreciation, we remove the accumulated depreciation in order to get the net book value. Other methods have the fair value. The fair value is the price that will be received to sell an asset. How much would you receive in order to sell an asset? Then whereas the value in use is it reflects entity specific current expectations about the amount, timing, and uncertainty of future cash flows. Under value in use, you look at how much do you expect to earn from this car. That it will always transport my maize and brings to Kampala. So how much am I earning from it? So that's the value in use. I'll value it according to how much I'm earning from it. Whereas the current cost reflects the current amount that would be paid to acquire an equivalent asset. How much would you pay in order to acquire an equivalent asset? Yeah. So you can look at also the factors to consider in selecting a measurement basis. Which characters you always consider in order to select a measurement basis. So, and let's look at the presentation and disclosure. So, presentation and disclosure. Under presentation, what are you supposed to disclose and what are you not supposed to disclose? So, now for the statement of profit and loss, what do you present? For the statement of profit and loss, it presents the entity's financial performance for the reporting entity and majorly looks at the incomes and expenses. So after looking at the incomes and expenses, unless it will give you whether the entity made a profit or a loss. Whereas the other comprehensive incomes, so we can combine it with profit and loss, and we call it the statement of profit and loss and other comprehensive incomes. So this one comes from incomes which have been earned but have not earned from, they cannot be used right now. So for example, when you get like incomes like revaluation surplus, when you get like fair value gain on investment property, so all those ones are other comprehensive incomes. Whereas in the statement of financial position, for it looks at the entity's financial standing as at that date. So at that date, how have you stood in terms of assets, in terms of liabilities, and in terms of equity. Whereas the statement of changes in equity looks at how your changes in equity, how your equity is changing in terms of retained earnings, in terms of surplus, in terms of shareholders' equity, all those ones. Then the statement of cash flows, which shows how your free cash flows are moving, how your income is coming in, and how it is going out. So, majorly that is our conceptual framework that's supposed to look at. Look for me in other videos. We're going to start at least looking at the international standards. We're going to look at we shall start with IFRS 15 probably. So we shall look at those standards. Follow me on Achievers Meeting Point. Meet you there. Love you, buddies.